squeak. Welcome back, my fellow investors. I'm Hammy, retired at 3, living off dividends. And today we are not doing a hypothetical. We are not doing a textbook example. Today we are talking about something that is happening right now, in real time, and that is sending shockwaves through every market on the planet. On February 28, 2026, the United States and Israel launched joint military strikes on Iran in an operation called Epic Fury. Iran retaliated, and in the process, a narrow stretch of water just 21 miles wide became the most economically important place on Earth, the Strait of Hormuz. If you've never heard of it, you're about to understand why it matters more to your daily life and your portfolio than almost anything else happening in the world right now. This is not political commentary. I have no interest in who is right or wrong in this conflict. My job, and yours as investors, is to understand the economic consequences and make informed decisions. So let's do that. Let me start with geography, because without it, nothing else makes sense. The Strait of Hormuz is a narrow channel of water connecting the Persian Gulf to the Gulf of Oman, and from there to the Arabian Sea and the rest of the world's oceans. At its narrowest point, 21 miles wide. That's it, 21 miles. Now, why does a 21-mile stretch of water matter to someone sitting in Chicago or London or Tokyo? Because of what flows through it. It also carries about 1/5 of the world's liquefied natural gas, LNG, much of it from Qatar, one of the largest LNG exporters on the planet, and significant volumes of fertilizer, aluminum, and petrochemical inputs that feed global supply chains. On one side of this strait, Iran, on the other, Oman. Iran's territory essentially wraps around 3 sides of the waterway, which means Iran has always had the theoretical ability to disrupt or close it, and on March 2, 2026, they did. Iran's Revolutionary Guard Corps announced the strait was closed. Any vessel attempting to pass would be, and I'm quoting here, set ablaze. At least 150 ships immediately anchored outside the strait. Tanker traffic dropped by roughly 70%. The world's most critical energy corridor went effectively dark. Some real-world data. By March 8th, Brent crude oil crossed $100 per barrel for the first time in 4 years. It peaked at $126 per barrel. The IEA called this the greatest global energy security challenge in history. When 20% of global oil supply suddenly cannot reach its buyers, the ripple effects are immediate, cascading, and global. Let me walk you through them. First, oil prices spike. That's the obvious one. Brent crude surged over 10% in the first 48 hours. But oil price increases don't stay in the oil market. They bleed into everything. Higher oil means higher fuel costs for airlines, trucking companies, shipping firms, and manufacturers. Those costs get passed on. Inflation goes up, not just in energy, in every product that requires transportation, packaging, or production using petrochemicals, which is most products. Real-world data. Goldman Sachs raised its 2026 US inflation forecast to 2.9% and cut GDP growth to 2.2% in a moderate scenario. In a more severe scenario with oil at $110 plus for a sustained period, they put US recession odds at 25 to 30%. Second, Gulf oil producers had to cut output. Iraq, Kuwait, Saudi Arabia, and the UAE collectively reduced production by over 10 million barrels per day by mid-March, not because they wanted to, but because their storage was filling up and tankers couldn't leave the strait to deliver their oil. You can't produce what you can't ship. Third, Qatar Energy declared force majeure on its LNG contracts. Force majeure means I cannot fulfill my contractual obligations due to circumstances beyond my control. Qatar supplies about 12 to 14% of Europe's LNG. When that supply stopped, Europe, which was already entering spring with gas storage at just 30% capacity after a harsh winter, faced a serious energy crunch. And fourth, financial markets reacted immediately. The S&P 500 dropped. The Dow fell over 400 points on March 2nd alone. Bond yields moved. Currency markets got volatile. The fear trade kicked in. Investors moved toward gold, defense stocks, and US energy producers. Here is where most people stop their analysis. Oil prices went up. Got it. But the Strait of Hormuz is not just an oil corridor. It is a supply chain corridor, and the implications go much further than your gas bill. Fertilizer. About 1/3 of all global fertilizer trade passes through the Strait of Hormuz. Most of it goes to Asia, but it affects global prices. Fertilizer prices in the US surged dramatically in weeks, and this is happening right at the spring planting season for corn and soy in the Midwest. If that disruption persists, food prices follow. Not immediately, but within months. The agricultural supply chain has a lag. Real-world data. Urea fertilizer prices jumped from $475 per metric ton to $680 per metric ton within weeks of the closure. Food inflation could follow within 2 to 3 crop cycles. Aluminum. The Gulf region produces significant volumes of aluminum using cheap energy. That aluminum feeds the auto industry, aerospace, construction, and consumer electronics globally. Tighter supply means higher prices across all of those sectors. Pharmaceuticals, plastics, rubber, electronics components. Many of these rely on petrochemical inputs that either transit the strait or are produced in Gulf facilities that are now disrupted. And shipping itself. Maersk and Hapag-Lloyd, two of the world's largest shipping companies, suspended their Middle East routes entirely. Ships are being rerouted around the Cape of Good Hope, the southern tip of Africa. That adds roughly 2 weeks to delivery times and thousands of dollars in additional fuel costs per voyage. Port congestion downstream in Asia and Europe is already building. Real-world data, UNCTAD warned that freight rate increases, insurance premium hikes, and rerouting costs will compound into higher prices for consumer goods globally, disproportionately impacting developing economies with less fiscal space to absorb the shock. Not all economies feel this equally. Let me tell you who is most exposed. Asia takes the biggest hit. China, India, Japan, and South Korea together account for roughly 75% of the oil and 59% of the LNG that normally flows through the strait. China gets about 1/3 of all its oil this way. Japan depends on this corridor for 70% of its crude. These are massive export-driven industrial economies, and they just lost a huge portion of their energy supply. India was granted a temporary emergency waiver by the US to purchase stranded Russian oil cargoes to stabilize its fuel prices. That tells you everything about how serious this is. Europe faces a second energy crisis. Coming off a harsh winter with storage already low, losing Qatari LNG at the moment. Europe needs to refill for next winter is a serious problem. Energy-intensive industries, chemicals, steel, manufacturing are imposing cost surcharges of up to 30%. Economists are warning about the risk of deindustrialization in some sectors if the disruption extends through summer. The Gulf states themselves, Saudi Arabia, the UAE, Kuwait, are caught in a bizarre situation. They have enormous oil wealth but cannot export it. Iraq shut down one of its biggest oil fields simply because storage was filling up. The GCC economic model is built on oil exports. When the tap is blocked, the entire fiscal model of these governments is under stress, and 80% of their food is imported through the strait, so they face a food security crisis in their own backyard. The United States is in a more complicated position. America is energy independent. It doesn't need Middle Eastern oil for its own consumption, but global oil is priced globally. When Brent goes to $120, WTI follows. American consumers still pay more at the pump, and US companies with global supply chains still face disruption. Historically, periods of elevated oil prices have been associated with stronger revenues for domestic energy producers, though individual company outcomes vary widely depending on cost structures, hedging positions, and market exposure. This is macroeconomic context only, not a prediction or recommendation regarding any specific company or sector. Real-world data. Oxford Economics modeled a scenario with oil at $140 per barrel for 2 months as the breaking point, enough to push the Eurozone, UK, and Japan into contraction and create an economic standstill in the US. Alright, I promised you we'd get to the investor angle. Here it is. Geopolitical shocks like this create both risks and opportunities. The key is not to panic and not to be reckless. Let me share how I'm thinking about this. The obvious trade that already happened. Energy stocks, defense stocks, and gold all surged at the onset of the conflict. If you were already holding those, good for you. Chasing them now, weeks into the crisis, is a different calculation. The risk premium is already priced in to a large degree. Oxford Economics noted that sharp moves in energy-related assets during geopolitical events have historically retraced as conflicts resolved. Their analysis suggests that pricing in sustained escalation carries significant risk, as a resolution or partial reopening of the strait could cause elevated prices to retrace quickly. This is analytical context drawn from third-party research, not a recommendation to buy or sell any security. Consult a licensed financial advisor before making any investment decisions. On the other side, GCC assets, Asian equity markets, and European industrials have fallen sharply due to war fears. Historically, markets in affected regions have recovered once geopolitical situations stabilized, though the timing and extent of any recovery is inherently unpredictable. This observation is historical and educational in nature, not a recommendation to purchase any asset class, region, or security. Past market behavior does not guarantee future results. Always consult a licensed financial professional before making any investment decision. Some financial commentators and risk managers have noted that geopolitical shocks of this magnitude can affect sector concentration in portfolios. General principles of diversification, widely discussed in academic finance, suggest that concentration in any single sector affected by a specific risk event warrants awareness. This is general educational context, not personalized financial advice. The appropriate response to any geopolitical event depends entirely on your individual financial situation, goals, and risk tolerance. Nobody, not analysts, governments, or hamsters, can predict how this resolves. Consult a licensed financial advisor for guidance specific to your circumstances. H. The Dallas Fed modeled that even a one-quarter closure of the strait would lower global GDP growth by an annualized 2.9 percentage points and push WTI to $98 per barrel. A longer closure pushes those numbers significantly higher. The duration of this crisis is the single biggest economic variable, and it is driven by military and diplomatic decisions, not market forces. Real-world data. The WTO warned that if oil and gas prices remain elevated for the rest of 2026, global GDP growth could be reduced by 0.3 percentage points. Goldman Sachs raised US recession odds to 30% under sustained disruption. Let me leave you with this. The Strait of Hormuz is 21 miles wide, but its closure is one of the largest supply shocks in the history of the global economy. The IEA called it the greatest energy security challenge in history. That is not hyperbole. That is the assessment of the most credible energy institution in the world. The economic consequences are real, and they are spreading through oil prices, gas prices, food prices, shipping costs, inflation, and GDP. They are hitting Asia hardest, Europe badly, and creating complicated trade-offs for the United States. As investors, our job is not to predict the geopolitics. Our job is to understand the economic mechanisms, stress test our portfolios against different scenarios, and make calm, informed decisions when others are panicking. This crisis will resolve. All crises do. The question is when and at what price. Stay informed, stay disciplined, and do not let fear make your financial decisions for you. I'll keep watching this, and I'll keep you updated as it develops. Subscribe if you want that analysis delivered to you. My fellow investors, stay sharp. Remember, this is not a financial, legal, or tax advice. Remember, I am just a sophisticated hamster. I just inform and educate.